And good morning, everyone. And this is a kind of a special training session or the workshop organized by the CBA faculty of the Institute of Chartered Accountants. And this actually mainly we are touching on the LKAS 12 income taxes, which is one of the key standards which my personal experience also, sometimes the people are struggling, specifically when it's coming to the deferred tax computations, how to compute the deferred taxes and the rates applicable for the taxes in determining the deferred tax and current tax liabilities. So those kind of a practical difficulties or the issues are also coming in. And this is a very good kind of an initiative of the faculty where it provides more insights or the practical application of this particular standard. The participants' materials we have distributed yesterday with the invitation by Samanthi, and hope you all have received those. And we are mainly focusing on the content of the presentation, and also some of the questions I have mentioned in the another Word document. That is also please take it also with you, then we can discuss those questions as well. And another implementation guidance issued by the IAS, the International Accounting Standards Board, also distributed, which also contained some of the more detailed technical explanations or the disclosure related certain applications, which sometimes we may not be able to discuss the entire the document during the today workshop, but you can leisurely go through, because it contains a heavy technical kind of discussions and the analysis where you can use for your day-to-day accounting related matters. And so hope everything is fine and we can commence the discussion. And also during the workshop or the training, if you come across any kind of issue, or if you need any further clarification, please provide it to the Q&A or the chat box. Then I can time to time go through that one and come into you with the explanations or the clarifications. And at the end of the session, also I am normally having a Q&A session where you are having a practical difficulties, or if you are having a current application issues, you can forward it to me. Then I can also have a look on those as well. And I think this would be a kind of a more interactive session. I hope everyone will keep in touch with me, and also wherever when I am approaching to you for a kind of explanation or Q&A, hope you have responding for those as well. And this LKAS 12, the income taxes, the taxes are coming through the legal enactments, the Inner Revenue Act. A recent amendment also made regarding the income taxes. Some of the income tax rates have been changed, and also certain kind of industries were exempted from the income taxes. And at the time of these revisions, there are certain practical difficulties also came across, and the institute has attended those and clarified how the applications would be. And these income taxes, the LKAS 12 is the main standard, which normally the popular standard dealing with the income taxes. However, the more than that, there are certain other accounting literature are also available on accounting for income taxes. Those are the relating to the SIC 25, which is the income taxes, changes in the tax status of an entity or shareholders. And recently, like 2 years back, another document was issued, which is the IFRIC 23, uncertainty over the income tax treatments. These SIC and the FIRC are the interpretations issued by the ISB And those are also part of the accounting standards. And the Institute of Chartered Accountants as the Sri Lanka standard issuing body. The institute has also adopted all of these three accounting standards in the Sri Lankan context. So there is no any variations between the LKAS 12 and the IS 12, and also these two interpretations. However, when it's come to the Sri Lanka accounting standards, Sri Lanka accounting standards is having the accounting pronouncements more than the IFRSs. The two pronouncements were issued by the institute, which is one is on the application of tax rates in the measurement of current and deferred taxes under LKAS 12. This particular the guide, which is a guideline issued by the institute, this was initially issued in 4 to 5 years back. However, it was confined to the deferred taxes. However, as I mentioned, very recently there was an amendment made to the Inland Revenue Act. Due to that, due to certain practical difficulties was encountered, and Institute had expanded the guidance by giving the further guidance on current taxes as well. So now we are having a more precise guideline which is available for application of tax rates in measurement of current tax and deferred taxes in LKAS 12. And the next one is on certain companies are enjoying a tax holiday period, the BOI registered companies. Those companies, the accounting treatment for income taxes or the more the principles behind the recognizing the tax liabilities for the tax holiday companies are mentioned in the this particular another pronouncement issued by the institute, which is on the taxation as per LKAS 12 income taxes to entities enjoying a tax holiday period. So both of them are accounting guidances issued by the institute, and all of these 5 pronouncements are dealing with the accounting for income taxes. And also sometimes I personally know sometimes the people are struggling even to find the pronouncement, the major content. Normally I have seen that sometimes the people are Google directly the LKAS 12 and getting the related pronouncement. But I'm not encouraging to Google it and find it out. The reason was sometimes when we are Googling and find out the pronouncement, the content coming up is not the latest version, because the accounting standards are changing time to time. The revisions are happening. The institute is making the certain local adjustments. So therefore, the content which is coming, the appearing when you are Googling and getting the pronouncement is not the latest one. So sometimes you might get wrong. Therefore, if you are finding out any kind of accounting standard or any pronouncement issued by the institute regarding the accounting, so you need to approach the Sri Lanka Accounting and Auditing Standards Committee website. So that website, which is, I will show it to you, because it is also sometimes I have seen the people are struggling where first I will show that, and then we can go. This is the hope now you can see the standard. This is not the institute website, which is the SLASC.lk. This particular website contains the accounting and auditing standards. Since we need the accounting standard, we should go to this one. Then it's coming to here. Then we can select the accounting standards from here. Then it coming the certain tabs. The Sri Lanka Accounting Standards bound volume. which is the full SLFRSs, and the Sri Lanka Accounting Standard for SMEs, if you are applying the SME, or the Sri Lanka Accounting Standard for small entities. And it also contains the financial reporting guidelines and rulings, then the certain other SOPs or the sorts issued by the institute. So all we can get from here. So if we go to this one, the bound volume, the latest bound volume will appear in this 2020 bound volume. Then when you are going to there, then you can get the LKAS 12 the standard or any standard. If you need the financial reporting guideline, which is just I mentioned the guideline application of tax rates, you can obtain from here. And the other one is on the guideline, which is on the BOI companies. Deferred tax ruling for BOI companies can also be obtained in here. And if you need to get this IFRICs issued by the institute, you can go to here, the IFRICs and 6, and you can obtain the related, the pronouncement. So I'm always encouraging you all to go to the slac.lk website and get the accounting pronouncements. The reason was sometimes if we just Google and obtain the accounting pronouncement, it might not be the latest version. But if you approach to this website and obtain it, then you can have the latest version of it. However, sometimes if you are working overseas, not in Sri Lanka, then there might be a difficulty in approaching or the accessing this particular website. The reason was this was actually limited to the Sri Lankan territory due to some of the specifications made by the IASB. Since the Sri Lanka, we are localizing the accounting pronouncements issued by the IASB. Due to that, we, as the institute, also adhere to some of their regulations and rules. Therefore, this particular accounting standards website is not accessible from the people who are working outside Sri Lanka. So you need to be in Sri Lanka to access this one. Therefore, if some of you all are approaching or working overseas, you might not be able to. However, on the other hand, if you are working outside, definitely the applicability of Sri Lanka accounting standards is also very much limited. Therefore, you may be directly, you need to access to the IASB website and obtain the related pronouncements. The people who are working in Sri Lanka, so the accounting standards are relevant for them, and this is the ideal place to obtain the related accounting guidances. Hope you all get this one. Since why I have mentioned this one, I have seen sometimes people are getting wrong since they are not approaching the or the accessing the correct accounting pronouncements. The reason was the accounting standards are amending and changing time to time. If you all are having any questions, you can put it those to the chat box. Any questions? Okay, so far not. Correct. So the scope of the standard also very much critical. When it's come to every standard, the standard first having a scope. The scope describe for what kind of transactions or events the related accounting standard is applicable. Sometimes, if we have not read out properly the scope of the standard, we may apply this particular standard for some of the transactions where the standard is not applicable. Therefore, before moving into every standard, not only the LKAS 12, you should first read the scope of the standard. then you get an idea for what kind of transactions this particular standard is relevant. Sometimes some of these standards are excluding certain transactions, though by appearance, though we may get a feeling like the standard, this particular transaction is within the scope of this particular standard, but sometimes there is scoping it out. So therefore, you need to first go and see the scope of the standard. So scope of the standard, this LKAS 12 says, LKAS 12 shall be applied in accounting for income taxes. So we are having so many taxes in Sri Lanka. However, the LKAS 12 is applicable only for income taxes. It is not applicable for the VAT, NBT anyway, abolished now, or any other related kind of sometimes the local authorities are charging certain taxes. So those taxes are not within the scope of this standard unless we can say it is an income tax. For example, some of the taxes are the income taxes actually charging based on the taxable profit. However, we know certain taxes are charging based on the revenue. So the ESC, which was there till I think the last year, the ESC is charging based on the revenue. And the turnover tax was there, which is charged on the revenue, which are not the kind of taxes which is based on the taxable profits. So therefore, the LKAS 12 says the income taxes include, there are two kinds of taxes, the all domestic and foreign taxes which are based on taxable profits. There should be a taxable profits, and by application of the tax rates, we should compute the income tax based on the taxable profits. And also the taxes such as withholding taxes, which are payable by a subsidiary, associate, or joint venture on distribution to the reporting entity. The withholding taxes, which are particularly on the dividend distributions, are also coming in the scope of the LKAS 12. So there are two kinds of taxes. One is on the taxes which are based on taxable profits, and also the withholding taxes. So those are the two particular taxes coming in here. So now sometimes you may have a kind of confusion. For other taxes, which standard do we need to refer to? Mainly, there was the kind of interpretation issued by the ISP, which is the IFRIC, I think IFRIC 19, which is on the levies. I may get wrong the number, but there's a particular interpretation issued by the ISP, which is on the levies, which is the ideal, the pronouncement you should refer when you are dealing with the other taxes other than the income taxes, which is the IFRIC issued on the levies. So you can get that pronouncement also from the SLAC website. It contains how to recognize those kind of taxes and other levies when we are accounting for them. However, for the income taxes, which are based on taxable profits and the withholding taxes, you should refer the LKAS 12 for the guidance. Now, there is a question which is on the income tax liability of a company is computed based on the revenue of the company. Do I need to apply LKAS 12 to determine the income tax related accounting? In practically, sometimes we have seen some of the companies still, specifically due to the BOI tax concessions, their accounting, their tax liability is computing based on the revenue of the company. Let's say the 2% of the revenue is the income tax charge. So now, based on your understanding, what do you think? Do we need to apply the LKAS 12 for such companies when deciding or determining the tax liabilities? And I have a few answers. I think around 35 are there. Can I have few answers, yes or no, for the chat box? Hope I'm audible to you all. My question was, sometimes some of the companies, their income tax liability is computing based on the revenue. The good example is certain BY companies I have seen, due to the tax concessions provided by the tax authorities, they are charging their income tax liability based on the revenue. If that particular company, do we need to apply the LKAS 12, or particularly do we need to go the other pronouncements which I have issued, I have just mentioned, which is on the levies for accounting their income tax? Can I have few answers, the Q&A or somewhere? Hope everyone is there with me. Yes or no, just providing is enough. Yeah, I'm getting the answers. People are saying no. Few more answers. Yeah, some are saying it's no, and some people are saying it's yes. So if just we refer to the scope says all domestic and foreign taxes which are based on taxable profits. Actually, this taxable profits was the taxable profits was defined in the standards also. So if I go to the standard and refer, if there's where you could refer this one. You can see my screen. So this is IAS 12, but exactly the same as LKAS 12. The standard contains the definitions, which is the paragraph 5. Paragraph 5 of the standard says the definitions. When it's come to the definitions, it says the taxable profit is the profit for a period determined in accordance with the rules established by the taxation authorities upon which the income taxes are payable. So the taxable profit is determined based on the rules issued by the taxation authorities in Sri Lankan context, the Inland Revenue Department, and upon which the income taxes is deriving. However, the standard also said when it's come to the taxable profits, actually this is based on the certain guidances issued by the some of the accounting firms, and also the certain interpretations issued by the ISB. It says like this taxable profit which mentioned in the LKAS 12 is a kind of a net figure. It should not be an absolute figure. For example, if particular tax is based on the volume, or if it is based on the revenue, that particular tax cannot be considered as an income tax for the purpose of LKAS 12. It is an income tax for the Inner Revenue Department or the tax consultants. However, when it's come to the accounting, it is not an income tax. It is a kind of a tax which is outside the scope of the LKAS 12. So therefore, the companies which are having the tax liability based on their revenue, like I mentioned some of the BOI regulations, those companies, the LKAS 12 provisions are not applicable. So those companies, there's no need to even book for the deferred taxes. The reason for it is not applicable unless they might have certain other different requirements. For example, if they are subject to the capital gain tax, which they might book for the capital gain tax separately. Otherwise, some of the business related taxes are not applicable most of the time. So I will not provide the exact answer. The reason was the regulations could be different from one company to other. However, the most of the instances where I have noted, if the company's income tax is based on the revenue, the deferred tax is not applicable except for some of the capital gain taxes. However, due to certain kind of other provisions, there might be a need for that one, where you need to refer based on the principles which I am going to discuss with you today. Based on those understanding, have a look and identify whether actually we need to scope this one or we need to book for the deferred taxes. So most of the time, my experience was if the company income tax is based on the revenue, the deferred tax is also not applicable for them since they are outside the scope of the LKAS 12. So any questions on that, you can put into this chat box. I like if you can, we can have a more interactive session. So my slide, is it visible to you now? I changed the from the LKAS 12 to the slide. Can you say yes or no whether my slide is visible to you or not?
Slide is visible.
Okay, thanks. Right. So that is the first thing which I need to highlight to you. Then when we are coming to the tax expense or the tax income, sometimes certain companies are having the negative figure, which is an expense in the P&L, or sometimes some of the people might have tax income, the positive figure, mainly due to the reversals of the deferred taxes. Sometimes the tax expense figure would become a positive figure, where it might be a certain income. The tax expense of a particular company, which is the amount going to be charged to the P&L, contains two parts. One is on the current tax and the deferred tax. Current tax is the amount of income tax payable in respect of the taxable profit for a period. For a given period, your tax expense or the company is computing based on the tax laws or regulations, like you are having the accounting profit, then you are adding certain disallowable expenses, or you are deducting certain allowable kind of the expenses. So based on that, you are deriving the taxable profit. Based on that, by application of the related tax rate, you are getting the tax charge, which is the current tax. So it is not a very difficult part. Your tax computation, which is done by the tax consultant or the company itself, is the current tax, which is going to be the charge to the P&L for the current period. However, for the purpose of the LKAS 12, not only this current tax, it is not the one and only the component of the tax expense. It has another component, which is the deferred tax, where actually I have seen the most of the time the people are struggling to derive the deferred tax figure. The deferred tax liabilities and certain deferred tax assets are there. So based on that, the deferred tax expense is deriving, which I will discuss with you in more detail in the coming few slides, how we should derive the deferred taxes. For the current taxes, it is not a very difficult part where you can directly obtain from or the traceable from the tax computation done by the company. And also sometimes I will say like certain companies, you may have over under provision, which is also a kind of, not that much unfamiliar to you, where the certain companies, when at the time of filing the tax return, there might have be certain adjustments to the income tax, and you are considering it as an estimate change, and the under adjustments are made in the subsequent period. So normally your current tax is coming in the current tax charge and also the under provision, which is also very much familiar to you. And those are the major component of the current taxes. So based on that, you are deciding the current tax expense for the current year. And that expense is charged to the P&L, and also you are recognizing a liability for the current taxes. And if you have already paid certain the tax installments during the period, you can deduct those and arrive the current tax liability at the end of the period or the balance sheet date. So you are having a P&L charge and a corresponding liability in the balance sheet, where you can name those as the current tax liabilities. So if you have already paid, you have to reduce whatever the payments you have made from the liability in the statement of financial position when you are getting that done. So no need to present the payments in the face of the balance sheet. You can have the net figure, the net liability at the face. However, in the detail note, you can have how much is the amount paid. Anyway, the income tax, the payment, the paid amount should have to be reflected in the cash flow statement as well. So the cash flow statement, normally under operating cash flows, there's a particular line item coming in. There you are providing the income tax payments. So income tax paid during the year, you can capture from the cash flow statement, which is also a mandatory requirement under LKAS 7 to present the income tax payments in the cash flow statement. So those are the presentation of the taxes. Recognize a current tax asset if the amount already paid exceeds the amount due and the excess is recoverable. Sometimes the people have overpaid certain taxes. If the amount is recoverable, you can present the tax asset. Or sometimes I have seen the certain companies are having the tax credits due to the withholding taxes or the ESC payments. So those companies are also having the tax assets. However, for example, when deciding the ESC is having a maximum number of years where you can carry forward the related the tax credits. So if they have expired, or if you feel like that before expiring also, since the company might not have the taxable profits, it's not recoverable, you should have to definitely write off those the tax credits. So only you can recognize a current tax asset or a tax asset based on tax credits if it is recoverable. So you have to consider the expiration, the criteria provided in the related legislations, and also whether the company is recoverable or the refunds, are we entitled to a refund from the IRB, or if not, the availability of the taxable profits in the future years based on the whatever the profits the company is forecasting. So based on that only, you can recognize a tax asset for whatever the amounts you have already paid and which is exceeding the amount due at the balance sheet date. And adjustments to the estimates of prior periods also shown in the current tax expense, which I have mentioned, which are the unlower provisions which are coming in due to certain adjustments making at the time of filing the tax returns. So those are not the errors, but those are certain estimations or sometimes the interpretation differences between the experts of the taxes. So therefore, those are adjusting in the current year, the tax expense. So these are the main kind of the accounting principles which you should have to learn on the income taxes. So this is not a very difficult part for you all, since you know this is kind of very much familiar to you all from the application perspective. So if you all are having any kind of Q&A on this particular content or the current taxes, you can provide. Will you send this slide to us? This has been already circulated, I think, yesterday. Hope you all should have received it at this moment. With the invitation, this has been circulated. So any other questions? You can refer it, which is on the current taxes. If you are having a kind of an issue, or if you need any further clarification, or if you feel like I need to re-explain, you can put it into this one. We have the time till 12:30, so we can have a kind of a more detailed discussion. Any Q&As? One is asking, can you kindly share the recording of the session? Augusta or the Samanthi would be able to answer this one. Then another one is asking, ESC written off due to expiration can be included under current taxes or considered separately as an expense. That one also actually, there are two kind of the companies, some companies we have seen, they are recognizing it as part of the admin expense, or certain companies, they are recognizing it part of the current tax expense. That too, the application is there, which sometimes somebody can argue and say the ESC, which is a tax credit, and normally if we have, if the ESC is capable, we can get a tax credit and your tax expense would reduce. Therefore, we are recognizing it charged to the P&L as a tax expense. That is also fine. And sometimes certain people might say this is not a part of the tax expense. This is kind of expiration due to ESC. So both the people are having the very valuable arguments, and they are recognizing it is part of the admin. Only thing is, I am suggesting to have a consistent application. If one particular year, if you charge it to the P&L as an admin expense, please follow that one consistently throughout all the periods by recognizing it, charging it to the P&L as an admin. However, if some company has decided to have a P&L charge as the income tax, that is also fine. So both approaches are the permissible, which is not a kind of a precise explanations are available. So you can justify, you can follow both the methods. Only thing is you should have to follow it consistently, one period to another. Will you send this slide to us? I think already this has been circulated by Samanthi yesterday with the invitation, I think. If you have not received it, you can approach to the Augusta or Samanthi to get the slide. I think definitely this might have been available or circulated with you all by now. This trust me, hope you have received the answer, which is the technical one that you have asked. And also it is a common kind of a questions normally people are getting. Any other questions? Yeah. Okay. Now we are moving to the deferred taxes. So current taxes, those are the things which you need to have a look. And when it's come to the deferred taxes, which is we are having the deferred tax liabilities and the deferred tax assets. So the deferred tax liabilities are the amounts of income taxes payable in future periods in respect of taxable temporary differences. And the deferred tax assets are the amounts of income taxes recoverable in future periods. It has three parts: the deductible temporary differences, the carry forward of unused tax losses, and the carry forward of unused tax credits. So we are having the majorly two components for the deferred taxes: the deferred tax liability and the deferred tax assets. In Sri Lanka, when it's come to a kind of an individual entity, we are filing one return. Therefore, we can reduce the deferred tax. The net figure can be presented by deducting the liability balance from the asset balance, or the net liability or the net asset can be presented. However, when it's come to the consolidated financial statements, the one particular, if the A company is having a net liability and a B company is having a net asset, those two cannot be set off because those two companies are individually filing the income tax returns. So they are having the two respective tax liabilities. Therefore, for the consolidation financial statement purposes, we can have the net asset balances and the net liability balances also. The reason was some of the individual companies might have net assets and some of the individual companies might have net liabilities. So I have seen some of the companies are doing a wrong accounting where they are netting off the individual account, individual entity-wise, the net positions are also in the balance sheet of the consolidated financial statements. So that is not permitted, where the set-off is only applicable if the company is having a one single the tax obligation, where that can be done at the individual or the separate financial statement of the company. However, not in the consolidated financial statements. Consolidated financial statements should reflect the individual net asset positions as a one single line item, the individual net liability position as another line item on the liability side. So that presentation is also some of the wrong accounting the people are doing when it's come to the presentation of the deferred tax assets and the liabilities in the consolidated financial statements. So the deferred taxes, we have identified the tax liability is coming in from the temporary differences, which are taxable temporary differences. And the assets are coming in for the deferred tax assets, which are based on the deductible temporary differences, the carried forward unused tax losses, and the carried forward tax credits. So now the question is coming in, how we should derive the temporary difference, because the liability or the asset, the temporary difference, I'm referring here the deferred tax liability or deferred tax asset. The key thing is to identify the temporary difference. The temporary difference is saying, is a temporary differences, this is, I'm mentioning the asset is the temporary differences of the assets which are recognized in the balance sheet. That means the assets are the PPE, investment property, the biological assets, the inventory, the financial assets, right? Based on that, how we should decide the temporary difference for a particular asset recognized in the balance sheet. So we have to consider the current amount of the asset, which is based on the statement of financial position, and we should have to deduct the tax base of it, which is the amount attributable to the asset for the tax purpose. This amount you can get from your tax return, and this amount you can get from your balance sheet. So you know the PPE or the intangible assets, which you can carry down the cost or the revalued model, and whatever the balance sheet, the PP amount is there the carrying amount for the purpose of in here. So the respective, whatever the carrying amount for the tax purpose can be obtained from your tax return. The tax return is contained the PPE after deducting the tax, the allowances, the whatever the carried forward balance is appearing in your the tax computation. Right. The investment properties are also there. The certain companies which are following the full SLFRSs are having investment properties under cost model and also the fair value one. The related carrying amount can be put in here. Then you are having the consumable biological assets, which are recognizing based on the fair value less cost asset. Then you are having the inventory, which are recognized the lower of cost and net realizable value. And then you might have the certain financial assets, which are recognized based on the amortized cost or the fair value. So those kind of assets are appearing in here, and the related tax base you can determine based on the Inland Revenue Act provisions, and it is appearing in the tax computations. And sometimes you may feel when it's coming to the discussion, sometimes certain assets are having the nil tax base due to certain the tax provisions applicable for them. So we will discuss those in detail. For the moment, what I am describing here is how to identify the temporary difference. The temporary difference we can identify. We can have more questions in later also by getting the carrying amount of the asset, which is based on the statement of financial position or the balance sheet, and we have to deduct the tax base from it, which is based on the tax computation. So after that, you are getting the temporary differences. So if the carrying amount of the asset is more than your tax base, that means your balance sheet figure is more than the tax computation, the carried forward figure, you are getting a taxable temporary difference, which ultimately ending up with the tax liability, deferred tax liability. And if your carrying amount is lower than the tax base, you are getting a deductible temporary difference where you are ending up with the deferred tax asset. So that's how you are getting. And also one other principle specifying in here, which also you need to make a note of that. It says if these economic benefits will not be taxable, tax base of an asset is equal to its carrying amount. Sometimes certain kind of entities are having the certain assets which are not entitled for any tax benefit. One of the key example is the traveling purpose vehicles, where the capital allowances are not permitted. Therefore, they are not having a tax base. That means we need to assume that those companies, the tax base of an asset is equal to its carrying amount. So ultimately, taxable temporary difference would become zero. So therefore, those kind of asset, if those are not entitled for taxes, we cannot claim. Then the tax base and the carrying amount we should assume as equal. So that is a kind of a general principle. There's another approach also there, but I will not discuss that one. But it's better if you can remember, like tax base and the carrying amounts are equal when it's coming to the economic benefits are not taxable. So which are coming in some of the few examples in future. So we are having 5 questions in here. So let's have a workout and see whether you could identify the tax base of this particular, the accounting kind of the questions which I have forward here. The 5 questions are there. So the first one is machine that cost of 400. So before that, let's see a Q&A is getting in. Which are refunds considered as tax credit in DTA. Refunds, normally the tax refunds we are recognizing as current tax assets. The reason was these are deriving from the current taxes and the refunds are available. The current tax asset is normally we are recognizing unless the expected period of recovery is more than 1 year, we can have a non-current one. Normally, it's not part of the deferred tax, but you can present it together with the current tax assets, which based on the recoverability, you can have a non-current figure or the current figure. What is the tax rate to be used for temporary differences to arrive at the DT if companies more one tax rates? Example, 18% and 24%, which I will discuss this one later on, which is a kind of the practical application issue. I might not have a slide for this one, but I will touch on how to do that one. So at the end of the session, Shastini, I will discuss this one. So I have not said its answer, but I will take it at the later. The 5 questions are there, which is on the deciding the tax base. Can you attend the first one? The machine that cost 400 has carrying amount of 360. The tax depreciation already claimed 120. The remainder is deductible for tax in future. What would be the tax base? I'm asking. Tax base. And you can compute the temporary difference also. If you can compute, that is also good. What would be the tax base and ultimately the temporary difference? Let's try. And can I have the questions also, then the answers for that also? Please put your answers to the chat box, then I can decide whether you can identify the tax base properly. Please put in your tax chat box. The first one, let's go one by one. Please compute both the tax base and the temporary difference, both. One is saying 280. Any other answers? Tax base is 280, the people are saying. How you have obtained it? It says the carrying value is 400 and you have already claimed tax depreciation 120, the capital allowances. 400 minus 120, you are getting the 280. Your 280 is the tax base. How about the taxable or the deductible temporary difference? Now you are having the carrying value of the asset based on the balance sheet, the 360, and you are having tax base of 280. So what will be the temporary difference? Your balance sheet item is more than your tax one because balance sheet 360. The 400 has carrying amount of 360, which is the balance sheet figure. And 280, you just now said, based on the tax base, 400 minus 120, that is the tax base. So the 360
is the balance sheet figure, the accounting base. Your tax base is 280. So your balance sheet figure is more than the tax figure. So you are having a taxable temporary difference. So how much is the taxable temporary difference? It is 360 minus 280, which is 80. So you are having a taxable temporary difference of 80. So if you all have not get the content, can you all raise your hand? If anyone feel like I need to re-explain. So you are having, you are having your tax base, which is the 400 minus 120. The cost is 400, and you have already claimed for the tax purpose 120. Now you are having a tax base of 400 minus 120, which is 280. So 280 is your tax base. So the balance sheet, we are having the accounting purpose depreciation would be different. Now you are having the balance sheet figure, the machine 400 has a carrying amount of 360, which is your accounting base, the 360. So the accounting base is 360, the tax base is 280. So the temporary difference is tax base minus the accounting base minus the tax base, which is 360 minus the 280. You are getting the 80. Since your accounting base is more than your tax base, you are having a taxable temporary difference of 80. Hope it is now clarified to you. The one participant has raised the hand. So the answers, I am happy if you could put in the chat box, rather putting in the Q&A box. The Q&A, if you are having questions, then you can put it into the Q&A. So I also can have a track on whatever the unanswered question also from there. Right. Then let's see the second one. The interest receivable recognized at carrying amount 60 will be taxed when received in cash in next period. So you are having an interest receivable recognized at carrying amount of 60 will be taxed when received in cash in next year. Actually, this scenario might not be relevant in Sri Lanka, but I have included here to explain to you the principles behind those. So this is kind of a hypothetical examples which are not relevant in Sri Lanka. For this is only the education purpose, I have included those. The interest receivable recognized at carrying amount 60. So your balance sheet having an interest receivable of 60 will be taxed when received in cash in next period. So next period, when you are receiving in cash only, you are getting the the tax entitlement. So what would be your tax base? Can you put the answers into the chat box? What would be the tax base? When received in cash, yes. So what would be the figure? What is the tax base? What would be your tax base? Now you are having interest receivable, which is in the balance sheet. However, it's coming to the taxes you are getting in when it is received only. Yeah, I'm getting the correct answer, which is 0. The tax base is 0. So you are having a tax base of 0. I will explain why. Now let's say the accounting base is 60. Since the accounting is doing based on the accrual accounting, however, when it's come to the tax accounting, the tax base would be the 0. The reason was taxes only you are entitled at the time of receiving it. So before that, we are not entitled. So since we are not entitled for the tax purposes, we cannot have an asset. The reason was at the time of receiving in the next year only, we are getting it. Kind of a cash basis accounting is applicable for the tax purposes. So if you have prepared your accounts for the tax purposes by based on applying the tax, I would say if you have prepared your balance sheet based on the tax regulations, then you might not have a carrying amount for that balance sheet. The reason was your entitlement is on cash basis, which is in the next year. So you are having an accounting base of 60 in the balance sheet. However, the taxes, the nothing. The entitlement is getting in the next year. So for the tax purpose, there's a no kind of an asset. So therefore, you are having a zero tax base. So your temporary difference is now 60 accounting base minus tax base of 0. So you are having again a taxable temporary difference of 60. So your accounting base is 60, the tax base is 0, since it is on the cash basis, it is not appearing for the tax purpose. And your taxable temporary difference is again 60, since 60 minus 0, the 60. So accounting base is more than the tax base. You are having a taxable temporary difference. Hope it clarifies you. Now let's move into the next one. The trade receivable carried at 150, revenue recognized in income statement and taxed in period just ended. Period just ended means the current period. What would be the tax base? You are having a trade receivable 150. Trade receivables are recognized based on the revenue. The revenue credit, the trade receivable debit 150. And the income statement, the revenue has been recognized. And also the tax also in the period just ended. Just ended means the current period. So what will be your tax base and the temporary difference? Can I have the answers? Can I have the answers? Temporary difference would be 150, one is saying. So the tax base, we are learning two concepts. One is on the tax base and the temporary difference. One is saying the 0, that would be the tax base. Somebody is saying 150. 150. Okay, let me explain. Here, trade receivables carried 150. If the revenue recognized in income statement taxed in period just ended means the current period. So current period, you are having a receivable of 150. The revenue for that one, for both the income tax purpose and the tax purpose, both have a similar treatment. That's why the accounting purpose also the revenue has been taxed. For the tax also the rate has been taxed. So your accounting is also on accrual basis. The tax is also in accrual basis. Same accounting. Same accounting means ultimately your accounting base and the tax base both are coming the same amount. So if the similar accounting is applicable in the tax and the accounting both, your tax base and the accounting base both are the same figure. Ultimately, no temporary difference. Temporary difference will become 0. So in here, the third example, since your trade receivable, the accounting and the tax accounting both are having the same figure, you are having the tax base also the same thing. So your accounting base also 150, the tax base also 150, then no temporary difference is there. But if I explain again the second one, you had two different accounting there. Accounting is on accrual basis, tax is on cash basis. So that's why the mismatch was there and a temporary difference was recognized. However, the third one, both are having the same accounting treatment. So both asset and the tax base are the same. The accounting and the tax base both are become the same figure, right? So, any questions on those? Any clarification if you need? I would like if you can refer it to me now, then I can attend it. Please forward me if you are having any questions, particularly on the second and third answers. First one would be a kind of a thing where you have familiar tax with. Since those are the hypothetical examples, sometimes you may have certain difficulties. This is just to explain to you the principles behind those. If you are having any questions, if I need to re-explain, please put it to me. Since we are having time till 12:30. So around 10:30, we can have a 10 minutes or the 15 minutes break. And he's putting it into the chat box. Tax base 150, is it correct? Yes. The reason was the accounting treatment and the tax treatment both are the same. So accounting treatment and the tax treatment both are the same means the tax base and the accounting base both are the similar. Third one, the reason was the trade receivables carried at 150, right? 150 is for the accounting purpose, right? Tax also the same treatment applied. That's why it says revenue has been recognized in income statement and taxed in the period. Both revenue recognized, the taxation also happened in the same period. Period just ended means the current period, right? So your accounting treatment and the tax treatment both are the same. So ultimately, tax purpose and the accounting purpose both are having receivable amounts. Since the treatment was same. So the same treatments are there, then the asset, the tax base and the accounting base both are become same. If a different accounting treatments are applicable, only you are having the taxable temporary difference or the deductible temporary difference. For example, the first one, the accounting and the tax had a different things. Second one, the accounting and the tax has a different thing. That's why you had a different, your tax base was different from the accounting base. However, third one, accounting and the tax both are having a similar accounting. So you will not have a kind of a difference between the tax base and the asset base, accounting base. That's why you are having the tax base of 150 and the accounting base of 150, and a temporary difference is 0. Right. Let's move into the fourth one. Loan receivable recorded at carrying amount of 110. Recovery period of loan will have no future tax consequences. So it is disregard for taxes. Some of the asset bases are there where it disregard for the taxes. The loan receivable regarded at carrying amount 110. Recovery of loan will have no future tax consequences. What would be the tax base? The principle was I have mentioned in my presentation. If not tax consequences, how we should determine the tax base. There are two methods. However, I prefer if we go by the one unique one, otherwise we will get confusions. What would be the tax base? Can I have some answers? 110. Zero. $110 and 0 both can be arguable, but I would prefer to go with one stance. One is on, I have explained in the previous slide, we say if the economic benefits will not be taxable, tax based on the asset is equal to its carrying amount. So here no tax consequence means we should have to assume your carrying amount is equal to tax amount which is 110 again. So both your accounting base and the tax bases are become 110, 110, and your temporary difference is 0. So to become your temporary difference is 0, since it does not have a tax consequences, you have to assume your tax base and the accounting base are the same. So therefore, in the instances where no future tax consequences are mentioned, you have to say your carrying amount, the accounting base and the tax base both are the same amount. That is the principle. So the ultimately target was to make your temporary difference 0. So no tax consequences, we are assuming the tax base and the accounting base both are the same amount. So any questions? Fifth one also the same thing. The dividend receivable from a subsidiary have a carrying amount of 100. The dividends are not taxable. So no tax consequences means the accounting base and the tax base both are the same. So your tax base also be 100. Hope so no temporary difference is resulting from that. Hope if you have questions, 5 examples are clear for you all. First one is on one of the common thing where the capital allowances for the assets I have discussed. And the second one is on where the 2 accounting treatments are applicable, where the accounting is on accrual, the tax is on cash. So how to recognize this one. The third one is both are having the same accounting treatment, where you are having the nil taxable temporary differences, where the accounting base and tax base become the same figure. Fourth and fifth down did no tax consequences, or we should decide the tax base. So that's the key, the principles which I need to discuss. Right. Now we are coming to the liability side. That means the balance sheet liabilities. Here all are on the balance sheet assets. First one is on a PP item. Second one is the invoice receivable, the financial asset. Trade receivable, the financial asset. Loan receivable, financial asset. Even is the financial asset. We have discussed. The liability side, we are having the certain liabilities in the balance sheet, which are having a different accounting treatments under the Inner Revenue Act. So most common liabilities are on the financial liabilities, which are having the fair value accounting for the certain derivatives or the liabilities, the fair value through P&L. And we are having the amortized cost. The most of the time, the loan payables, the debenture payables are on amortized cost, or the trade payable also one of the thing which we are recognizing on the amortized cost. And you are having the retirement benefit application, which is your gratuity obligation. The most of anyway the companies applying the SLFRSS, you are having the actuary valued retirement benefit obligation. And those are the key, the liabilities you can have in your balance sheet. And the tax base of those are determined based on the Inner Revenue Act. So similar kind of principles you need to have a look when you are applying the recognizing the tax base or the temporary differences for these kind of the liabilities. So at the time of settlement, you are getting the benefits from the Inner Revenue Department when it considering about the liabilities. So let's see how we should get in here. And also, if you are similar to the asset, this is the other way around. If your liability in the balance sheet is more than your tax base, you are having a deductible temporary difference. If your carrying amount of the liability is lower than the tax base, you are having a taxable temporary difference. Carrying amount of the liability, since you are getting the tax benefit at the time of settlement, that's the reason you are having the current amount of liability. If it is more than the tax base, you are having a deductible temporary. So let's see, try and see these 5 examples where it says the current liabilities include the accrued expense with the carrying value of 100 The related expense will be deducted for tax purposes on a cash basis. So what will be the tax base? This is a hypothetical example. Sri Lanka, actually, the expenses are recognized in also on the accrual basis for the Revenue Act purposes also. But to explain to you all the principle, I have put this one, where the current liabilities include accrued expense with a carrying value of 100. The related expense will be deducted for tax purposes on cash basis. So your accounting treatment is on accrual, tax treatment is on cash basis. What will be your tax base and the temporary difference? Say, please be mindful when mentioning the temporary differences, mention whether it's a deductible or the taxable, which is also key. The reason was ultimately it leads to the liability or the asset. If you have not identified properly in your accounts, when it's coming to the preparing the balance sheet, you may have your own account. And since you have not identified properly the taxable and the deductible temporary differences. Here, what will be your tax base and the temporary difference? Can I have a few answers? Some is saying 0, one is saying, I think this is where the figures are. Any other ones? Hope you all are interacting with me and you might not fed up. Tax base is 0. Any other answers? Any answers? Tax base is 0. Okay, I think now you got the same which I have explained in the asset side also. If you have different accounting treatment, so you have a different accounting base and tax base. So here your tax purpose, it's on cash basis, your tax base is 0. Now your temporary difference is accounting base 100, tax base 0, the temporary difference is 100. Accounting base is more than tax base, this is a liability. So you are in a deductible. So deductible temporary difference of 100 is coming in. Your tax base is 0, accounting base is 100. Temporary difference is the deductible temporary difference of 100. Now let's move into the second one. The liabilities include the accruals for fines and penalties 100 that will never be tax deductible. So Sri Lanka also the same treatment, where fines and penalties accrual is there, but it will never be taxable. So if one liability is not having a tax consequences, I explained for the asset size also how we should determine the tax base. So what would be the tax base and the temporary difference? What will be the answer? One is saying tax base is 0. I prefer go with one kind of approach where no tax consequences. We should assume that both the accounting base and the tax base are 0 to derive the tax deductible temporary difference as 0. So we can say since no tax consequences, the tax base also 100. However, there's an alternative treatment where you can have the tax base also 0 and your deductible temporary differences will come in 100. And when deriving the tax, deferred tax assets or liability, you should have applied the 0 rate. So rather explaining that one, I prefer if you go with this one also, the same figure will appear in. So, and it's easier to you to remember or the apply. Liabilities include a long-term loan of 250. The repayment of loan will have no tax implications. Again, the same thing. Yeah, you can have the same the accounting base and the tax base, which your temporary difference would become 0. So fourth one, let's say the liabilities include the interest received in advance of 100 with a carrying value of 100. The related interest revenue was taxed on cash basis. See? What would be your accounting base? It also having a different account treatment, but only thing is the advances you have received now for the accounting purpose, you are having a liability, but tax purpose, it's already based on the cash basis recognized in the recognized for the tax purposes for the taxable income. The liability include means for the accounting purpose, this advance become revenue in the coming years, but taxes already have done. What would be the tax base? So different accounting treatment. So that means you should have different tax base and a accounting base. Can I have the answers for the tax base? Do we need to calculate for all the assets and liabilities in the balance sheet? Ideally, yes. Sometimes based on your understanding, you know where the differences are resulting. Since Sri Lanka actually now due to the revision to the Inner Revenue Act in year the 2017 Act, most of the time the accounting treatment and the tax treatments are the same except for some certain kind of differences mentioned in the Act. So therefore, most of the time the temporary differences are resulting from few line items in the balance sheet. However, we should actually have a kind of a look on the each and every item. So I have seen sometimes based on your experience, the people are getting the result in the temporary differences. Therefore, certain people might not consider certain temporary differences which actually have to be considered. So therefore, I encourage you all to have a look on each line item in the balance sheet. That is the ideal method. And you can have a kind of a reconciliation with your tax computation also. So by referring to both only, you can get this one. That's why when it's come to the deferred tax calculations, you cannot decide it based on your own, where if you are having a thorough understanding of the income taxes, you can do it based on that understanding. However, if a normal accountant or even an auditor, you should ask for both the balance sheet and the tax computation. After that only you can decide the taxable or the deductible temporary differences and ultimately the deferred tax asset and the liability. The reason was the accounting treatments and the tax treatments both are to be considered in determining the deferred tax figures. That's why normally the people are getting wrong. So you should have your the balance sheet and the tax computation both to compute the deferred tax. That is necessary. So can I have this answer? One is saying the temporary difference is 100. And other answers? Can I have few more answers? Hope you all have not fed up with this one. Around 10:30 we can have the 15 minutes break. Temporary difference 100, tax base is 0. Okay, now I think you understood what I mentioned. The different accounting treatment, different rates. Here also, the tax base is 0 and the temporary difference is 100. Let's say fifth one, what is the tax base in for above if the revenue will be taxed when recognized in the profit or loss? Let's say the fifth one, the same thing, but revenue is recognized, taxed when recognized in P&L. So both are on accrual basis. So what would be your the tax base and the temporary difference? Let's have the final one, the fifth one. What will be the tax base? If you can answer all 10, which I have mentioned in here, you are comfortable with the accounting for deferred taxes. I would say 100%, but around 90-95%, you can compute a correct accounting, correct deferred tax. The reason was most of the time we are getting those things. Both are 100. Okay. I have mentioned like accounting treatment and the tax treatment both are same, both are having the same tax base and the accounting base. Yes, here we are having, both are having accrual accounting, so that's why we are having the same thing. So few takeaways where the accounting treatments and the tax treatments both are the same. If that is the case, no temporary differences are resulting. So your accounting base and the tax bases are same. If you are having the mismatches, like your accounting is on accrual basis, always your accounting is on accrual basis. Tax treatment can be on a cash basis, then you are having a temporary differences. So I have explained. Third one is the one of the other common thing was coming from these assets, where the PPE and the intangible assets or the investment properties, where you are having the capital allowances claiming in a different rates, and where the rates are different to the accounting depreciation rate. So you are accounting the carrying value is different to your tax carrying value. So there you are having a temporary difference. That is also one of the key things which you are having. So those are the few things. And the other thing is, if you are having an asset or a liability which are not having the tax consequences in future, you should assume like your accounting base and the tax base both are the same. So the ultimate purpose was from that particular assets, there should not be a kind of a temporary difference in future. Right. So hope you understood this one. Right. So now we are having the 10 explanations. So if you are having any Q&As on this particular so far what we have discussed on the current taxes and the deferred taxes, just forward it to me. Then I can answer those and move into the next one. So put it into the Q&A if you are having. Put it into the chat box if you are having any other kind of questions. So I would give another 2 minutes to 10:10 if you are having questions to raise in the Q&A. No questions. Let me check in the chat box whether ideally if you could put in the Q&A the questions, that's ideal because I can have a track on the unanswered questions. Any questions? So hope it clarified. So can I have some reactions where say we are fine? Can go ahead. Can consider all assets and liabilities for deferred tax consideration. Yeah, you should actually, that's why I said you should consider only things, not the taxable temporary differences or the deductible temporary differences are not coming in for each and every asset and liability, but you should at least have a look and see whether they also are having a different tax treatments and therefore whether they are having a different tax consequence, different temporary differences are deriving. You should consider all the assets and liabilities. But based on your judgment, the experience when it's coming to if a particular company, if you have computed the 1 year, the tax computation, if no changes to the company or specifically no changes to the tax laws will happen, the few effort might be there, but you should consider. So whenever a revision to the income tax rates happened, one of the key instance was where the after budget reading, the Parliament, the Minister of Finance is when he's reading the budget, the proposing various amendments to the Inner Revenue Act, and later the amendments are coming as a legislation, which is approved by the Parliament, amendment to the Inner Revenue Act. Once these amendments was enacted, or the substantially enacted, you should consider those rates or the tax provisions for the computation of your deferred tax and the current tax assets and liabilities. So you should keep alert on the changes or the revisions to the tax tax laws as well, which is one of the key application issues arose since the if I discuss that one, the initially kind of a notice issued by the Inner Revenue Department after the budget reading, as certain changes were happened to the taxes, and the tax consultants were followed that ruling based on the instructions provided by the Department of Inner Revenue. However, when it's coming to the accounting for those, there is a kind of a argument or the kind of a discussion arose where, based on the accounting treatments, we were not able to apply those provisions because for the purpose of the LKAS 12, the tax rates we should apply, but which are substantially enacted at least at the balance sheet date. So therefore, up until the first reading of the budget, first reading of the amendment to the Inner Revenue Act happened, we have to wait. So that also the decision took by the institute and the interpretation committee, and a kind of a guideline also issued based on that. So it is the pronouncement which I have referred in the my discussion, which we can take those also at the end of the discussion for the discussion, which is a kind of a particular thing. So whenever the kind of can you issue us a participation certificate in a letterhead after maybe it's over to the Augusta or the Samanthi to have a look whether they are asking a kind of a participation certificate for this particular one. Right. Okay. Right. So any other Q&As? So far not. Right. Now we are moving to another kind of a principle, which is a little bit, sometimes people would feel this is a kind of not much easier to understand. So if you have not understood it by the first time, please let me alert that one, then I can re-explain it. And also I'm suggesting you to have a look on this after the discussion also, because this is an area where sometimes I feel the people are not that much aware. Also, this is a kind of a principle that people are struggling to understand also. This is on the deferred taxes on the initial recognition of an asset or liability. The temporary differences arising from initial recognition of an asset or liability in transaction, which is not a business combination, and at the time of the transaction affects neither the accounting profit nor taxable profit, then the deferred tax assets and the deferred tax liabilities are not recognized. Which says sometimes, anyway, the business combinations I haven't going to discuss in the today discussion. whenever, just for your information, if I am saying, for example, if you are having a business combination, which is normally the accounting treatment is based on the SLFRS 3, you should have to fair value the acquiree's assets and the liabilities at the time of acquiring the subsidiary company. So those fair valuation, you should recognize the deferred tax assets and the liabilities based on the resulting temporary differences due to the fair valuation. The fair valuation is doing only for the acquisition purpose. So though in your consolidated financial statements, these assets are appearing first time in your balance sheet. However, since it is a business combination, the temporary differences should have to be recognized. So that is the principle where I will not going to touch in detail today's discussion. However, for your information, please be mindful. When you are having a business combination, if you have fair valued assets, the resulting temporary differences are to be recognized in your consolidated financial statements as a deferred tax liability. And that liability should have to be also considered when you are computing the goodwill or the bargain purchase also. That is the one of the key principle in the accounting. However, there are certain transactions, the acquisitions or the assets or the recognition of the liabilities are there, where those are not business combinations. And at the time of the transaction affects neither the accounting profit or the taxable profit. Let's say one example. If you have purchased a motor vehicle, the motor vehicle only I am purchasing. Let's say not a motor vehicle, let's say the machinery item. We are purchasing a machinery item. This is not a business combination the most of the time. Then you are having the asset, and also at the time of the transactions, you are not having a kind of a accounting or the taxable consequence. So the reason was, let's say, your double entry would be the machine debit and the related cash or the payable credit. So no impact to the P&L or the tax figure was arise. However, when it's come to the year end, you are having the depreciation and the capital allowances claim, where it impact your taxable profit or the your accounting profit. However, at the time of the recognition, you are not having this where impact to your accounting profit or the taxable profit. So that's why when we are recognizing the machinery item, the first day we are not providing for the deferred taxes. The deferred taxes are providing only at the financial reporting period end. The reason was at the time of recognizing the asset, no consequence to the accounting profit or the taxable profit. So if I re-explain it one, if you are acquiring a machinery item, your double entry would be the machinery item debit and the liability or the cash would be credit. So your deferred tax on this machinery is recognized only after the period end. Normally for the companies who are not preparing the interim financial statements, at the year-end financial statements, you are recognizing the temporary difference. Since the reason for this not recognizing the temporary difference at the time of acquisition was due to this principle. However, the certain assets and the liabilities are there when you are at the time of the acquisition also, you are entitled for an accounting claim or a tax claim. One particular example was, if I could recall, this the plantations companies, which they are entitled to claim the replanting related expenses at the time of incurring. So at the time of incurring means at the time of the recognizing the asset, you are entitled for the claim of the tax. So your tax profit will be affected at the time of recognizing the asset. So the day one itself, you have to recognize the related tax consequences. Right. Then for the liability, if I am saying, let's say you are recognizing your gratuity liability the first time, the entry would goes to the P&L debit and the liability credit. So there is an impact to the P&L. So you should have to recognize the related tax consequences at the time of recognizing the liability. So that is the initial recognition concept. And also, one other addition to this one is certain assets where you are having no tax consequences are also due to this initial recognition concept. For example, the motor vehicle traveling purposes, we are not recognizing any kind of a tax liability by applying this initial recognition principle, where even after the at the time of the initial recognition also they doesn't have any tax consequences, after also not having a tax consequences. So that's why you are not recognizing the DTA or DTS. So that is a kind of a principle which I need to explain. So don't confuse that one. I am explaining to you the logic behind why we are not recognizing the tax consequences at the time of initial recognizing certain assets. However, this is not applicable for the business combination, which I have discussed. So if you are having a business combination, please be mindful to recognize the deferred tax liability the first instance, when the date in the business combination was happened. So that two things I have explained to you. One is on the business combinations. The fair valuations, you should have recognized the deferred tax liability at the date of the business combination and should consider for your goodwill or the bargain purchase computation. Second one is the certain assets or the liabilities which at the time of the acquisition are not affecting to the accounting profit or the taxable profit and are also not deriving based on the business combination. You should not recognize deferred tax assets or the liabilities. Right. So we are having a question also. An entity intends to use an asset which costs 1,000 throughout its useful life for 5 years and then dispose of it for a residual value of nil. The tax rate is 40%. Depreciation of the asset is not deductible for tax purposes. On disposal, any capital gain would not be taxable. So no tax consequences. As it recovers the carrying amount of the asset, the entity will earn taxable income of 1,000. However, since there is no tax consequences, we are not recognizing a deferred tax liability. The reason was since those are not having the tax consequences. That's why the reason behind we are not recognizing the taxable temporary differences, the consequences for the motor vehicles and all. So this is one of the key accounting principles. Sometimes when it's coming to more detailed explanation, you might require this understanding. But for a smaller company, if you are doing the accounting, these kind of the complex kind of accounting principles might not be relevant. So though sometimes you may feel do we need to have a kind of these kind of explanations for this particular one. It is a very much a very basic thing. However, a kind of a different level, kind of a complex accounting treatments, you should have this knowledge where I have just explained in a simple words. However, you can have a more look on this one, but for the smaller companies, this is might not be that much relevant. Then we have to decide the tax rates applicable for the assets also. It says based on how the entity expects at the reporting date to recover or settle the carrying amount of the assets, we should have a different tax assets and the liabilities. For example, most of the time we are expecting the PP and E to recover through their use. So normally we are applying the rate where applicable for them for the usage, the business tax rate. However, sometimes if you have categorized those as the held for sale or somewhere, then if the different tax rates are applicable, you should have to apply the different tax rate for those temporary differences. So most of the time, the business assets where you are using for the business purposes in Sri Lanka, you are having a common tax rate, unless the Shashni mentioned due to this the revisions to the Inland Revenue Act, now certain companies are having two different tax rates, which I will take up in later, where you are having a two different tax bases. what the key principle behind is, when you are recognizing the deferred tax assets and the liabilities, the rates you should apply based on your intention, whether you are going to recover it through use or you are going to sell it. However, one exception is there where the land, if you are considering, there is a presumption that land, the values are always recovering through sale, since it is a non-depreciable asset and having indefinite useful life. So land, though you are expecting to recover, though you are expecting to use for your business purpose, we should always assume you are recovering the land value through sale. That's the kind of accounting principle again. So other assets you can apply your intention, whether you are going to recover it through use or through sale based on intention. But land could be investment property or a PP item. You should assume you are always recovering this through sale. So are there any questions? Then we can have discuss. I think before getting the break, 10:30, if you are having any questions, you can move forward.
In the year 2019-20, the income tax rate of the company was 24%, but the rate used to defer at 28%. Reason was the amendments to the IRA. Yes, I will explain in the next coming slide is on that one. With that, I will explain that one. Any other questions? So since any other questions can I have? Okay, so I think another questions also there. If you can give answers at the same time, it's better for understanding. I think I have answered all these. Maybe the Shasni's one, actually, it's relevant for the next slide. And these different accounting rates I have not taken in here. The reason was it might not be relevant for most of you all and might be confused. So it might be relevant at the end to discuss those kind of applications. So that's why I kept those for the discussion at the end. If you are having any questions relating to the current taxes or the deferred tax principles, which I have explained to you all so far, please forward it to me. Okay, if you don't have any other questions, we can have a break around 15 minutes. Let's say the 10:45, we can come back. Hope everyone came back. Can I have few yes or thumbs up to say like you all are back? Okay. I think around 38 I can see. Say something, yes or something to indicate that you all are here. Yes, yes. Okay. Fine. Right. So we can move into the discussion again. Right. This is one particularly related to the Shasni's question also, which is the tax rate. So the measurement of the deferred taxes, what would be the tax rate we should have to use? We should have to use the tax rates that have been enacted or the substantively enacted. Not only for the deferred taxes, the same principle is applicable for the current taxes also. That's why, though for the December year-end company, the December 2020, the year-ended companies had a mismatch where the tax, the rates applied for the determination of the income tax liability by the tax consultants were different to the tax rates applied by the accountants for the accounting purpose. The reason was, as per the LKAS 12, the tax rate should have to be enacted or substantially enacted. Not only the rate, even to determine the certain kind of, let's say, the capital the capital allowances might be different due to the amendments made to the tax legislations. So that are also to be thus enacted or substantially enacted as at the reporting date, to consider those as substantially enacted at least. This was a kind of a confusion arose within the industry due to these certain revisions made to the Act by the Inland Revenue Act. So therefore, the Institute of Chartered Accountants has to issue a kind of a guideline. So this guideline, I will explain, since Shasni also asked about that one. This was initially when there is a kind of an industry specific or a kind of a widely applicable accounting, the implementation or the interpretation issue is coming in. There is a particular committee established or formed at the Institute of Chartered Accountants, which is the Financial Reporting Standards Implementation and the Interpretation Committee. And the committee is issuing a kind of a guideline. Later, it is approved by the Accounting Standards Committee also. This particular kind of the accounting guideline is part of the accounting standards also, since the LKAS 1 says the guidelines issued by the Institute of Chartered Accountants of Sri Lanka are also part of the Sri Lanka accounting standards. So therefore, though this is a guideline, it is part of the Sri Lankan accounting standards as well. So this is a guideline which provides more clarity on what is the applicable tax rate for the respective year-enders. Mainly the year-enders affected from this is the 2020 December year-ended companies and the 2021 year-ended companies, the March year-ended companies. So therefore, this guideline statement specifically for the year-ended companies after 26th March 2021. The reason to have this odd date was there are certain companies, the multinationals, which they are preparing their accounts for 52 weeks, where they might have a kind of a different, like a 27th March would be their year-end, like that. So anyway, the 31st March year-ended companies the most commonly we can see in Sri Lanka. So the 31st March year-ended companies actually can apply the provisions of those. And the 31st December 2020 year-ended companies were not permitted to apply this particular guideline. So they have to go ahead with the previous tax rates which are prevailed before the amendments to the Inland Revenue Act. So there could be still the December year-end companies, let's say if they are finalizing their accounts by now, the 2020 December companies, still they have to apply the old rate, and in disclosure note under the events after the reporting period, they can have to say like revision to the act, the trades happened, and due to that, in the ensuing financial period can have the company is having a different tax rate, and the effect can also to be disclosed. However, the March year-ended companies can go ahead with these nil rates. The ultimate conclusion was the substantially enacted tax rate is the tax rate at least we should have to apply in the determination of the current taxes and the deferred taxes. However, based on the interpretation committee view, the substantially enacted means the bill introducing the changes being taken up at the parliament for the first reading. The reason was when there is an amendment to the Inland Revenue Act or any other act is happening, first there is a bill tabled at the parliament, and that there is a protocol established through the standard orders and the provisions, the articles of the constitution of the Sri Lanka. There are certain protocols to be followed, and the bill has to go through the several readings, the first reading, the second reading, and the third reading. And after that, the speaker has to certify that particular the legislation, the act or the amendment to the act to become a law in Sri Lanka. However, since it says substantively enacted, it doesn't say like the enacted, it says substantially enacted, where we can say with a reasonable, without a reasonable doubt, like this amendment will be happen. So that one will be have like the bill introduced to the parliament when it's come to the first reading. We have considered, the Institute Interpretation Committee has considered some other aspects, like currently the parliament is having a government which is a majority government, and based on that, the committee has decided to say like a first reading itself can consider as substantially enacted. But if the parliament had a kind of a minority government, we have experienced certain minority governments where they are in Sri Lanka. After especially the 2015 presidential election, we had a minority government, and also before that also we had certain minority governments. But for the majority government we are having, and the ruling party is having the well majority, the Institute Interpretation Committee's view was the substantially enacted was after the first reading. And this is not only a Sri Lankan specific case. The Interpretation Committee has gone through the several other countries, how they apply. There are countries how they have interpreted, and there are certain interpretation issued by some of the other standards set in some other countries as well. So having taken into the consideration, this was the given date, where the first reading was happening 26th March. Therefore, any company who's having a year end after 26th March 2021 can go ahead with this revised tax rate. So other companies cannot. The reason was, though it is a kind of instructions were given by the Ministry of Finance, and later it was instructed by the Department of Inland Revenue, but for the legal perspective, the protocols to be followed, based on that, for the accounting purpose, we cannot consider those as substantially enacted. So that's the reason only the 31st March year-ended companies, or the companies which are having a period ended on or after 26th March 2021 can apply this deferred tax, the revised tax rate for the determination of current and the deferred taxes. So I am re-insisting for the companies which are having a 31st December 2020 year-ended and are finalizing their accounts by now, still they cannot apply the revised tax rates, because the reason was we have to apply the rates which are prevailed or the enacted or the substantially enacted as at the reporting date, not only the subsequent reporting date. So if subsequently we have came across like a revision to the rates, we can have a note under the events of the reporting period saying like the revision to the rate was happened and the impact can also be disclosed as per the LKAS step. So this clarified you. Any other questions on this one? The rates apply. And also this is applicable for the income tax rates and the deferred tax. And also the deferred taxes are much more futuristic. So we should have to consider the future tax consequences also. Now this revision was happened. There are certain, let's say the companies who are engaging in the, especially the agricultural business, were exempted from 5 years period. From a particular period to the 5-year period. So that particular period when we are deriving the deferred taxes have a 0 rate for the temporary differences which are going to reverse during that period. And after that, we can have the normal tax rate. So those kind of things are also to be considered when deciding the deferred taxes. So any other questions? I think Shasni, if you need any clarification, you can forward. Shasni must ask particular questions on this one to explain this one. Okay. Right. We can move into the next slide. And the other thing, the principle in the standard was like the deferred taxes cannot be discounted, which is a kind of a principle established due to some practical difficulties actually that was initiated to the standard. We cannot discount the deferred taxes. And also the one other thing was like if we are presenting our statement of financial position by segregating the assets and liabilities as current and non-current, the deferred tax assets and the liabilities are coming as non-current always. The reason was though we are expecting some kind of a reversal in the next coming financial year within 12 months also, however, a null segregation is happening. So therefore, we are having the non-current. And also the discounting is not permitted. Normally, if we are having more futuristic funds, we are treating like the gratuity liabilities, we are discounting. And the financial instruments related liabilities, we are discounting. However, the deferred taxes are having its unique feature where the discounting is not permitted under the accounting standard. Any questions? Do you have any questions? You can forward it to me. Okay. Now we are moving to another concept, which is on the deferred tax adjustments for fair valuation, which I have provided you a set of another questions also, which we can take up at the end of the session. There also I have mentioned specifically certain kind of the fair valuation where we can work out those questions in one go. And the principle I would like to explain in here, which is on the deferred tax adjustments for the fair valuation. Can I have a few kind of examples from you? What kind of assets or the liabilities we can have the fair valuation under the accounting standards? In the chat box, please provide few.
what kind of assets normally you are experience like having a fair value accounting. In the chat box, please provide few answers. In the chat box, where are the assets where you are applying the fair valuation under full SLFRSs? PP, yeah. Investment property, yeah. Intangible assets. Intangible assets actually, though this is not relevant to the LKAS 12, but we say like intangible assets to apply the revaluation model, there should be an active market. So since the Sri Lankan context for the intangible assets, since they not have, and since there is no any active market in Sri Lanka for the intangible assets in Sri Lanka, we are not applying the revaluation model for the subsequent recognition. Initial recognition, the fair valuation would be there based on the certain accounting treatments for the share-based payment or somewhere. However, for the subsequent measurement, the intangible asset, the revaluation model is rarely, or I would say not seen in Sri Lanka. The reason was no active market is available. However, for the PPE, in IP, yes. Any other things, the fair valuation? How about the consumer biological assets? Then non-current assets held for sale, also sometimes having a fair value if the fair value amount is lower. So we are having a different kind of, and the other one is on the financial instruments where we are having the fair value through P&L and also the OCI. Those are also the assets which are having the fair value accounting. And this says the difference between the carrying value of a revalued asset and its tax base is a temporary difference. So let's say investment property was fair valued 200, and if it is entitled for the capital allowances having a tax written down value of 60, 100 minus 60 is a temporary difference. So whatever the markup or the whatever the additional amount coming to the asset as the fair value gain is a temporary difference. If it is a after fair value loss, if we are getting again a temporary difference. So whatever the asset which has been fair valued, your accounting base would be the fair valued asset. Your tax treatment would be, the tax base would be the whatever the asset as per the tax computation, and the temporary difference would result in. So anyway, the fair value, the margin, or whatever the additional amount coming to the fair valuation is a temporary difference. In Sri Lanka, actually, at the time of the fair valuation, most of the assets we can say the fair valuation is not subject to tax, and the taxable or the tax liabilities are coming in when the fair value realizations are happening. And also, like one other example, when I'm mentioning, I have mentioned like these tax rates you have to decide based on your intention to recover those assets through sale or through use. However, I have mentioned for the land, which is an undepreciable asset, and using the revaluation model, you should assume like we are recovering that asset through sale. Is a presumption. So there was a confusion arose at the time of the enactment of this 2017, the Inner Revenue Act, where the capital gain was introduced in Sri Lanka for that act, and the applicability of the tax rate was decided based on that. And for every land, we should have to recognize a kind of a capital gain tax based on the classification of the business asset or the investment asset. The reason was the land, actually we should have to, whatever the revalued land, we should have to assume we are recovering that through sale. The reason was the land is having a indefinite, indefinite useful lifetime. Then it says the investment property. investment properties, can I have a kind of a what in the chat box? Please put what kind of assets we are classifying as investment property. I am actually checking the understanding of the other standards also. Normally for the intangible investment property, what kind of assets? Building, yeah. Only the building? Land? Yeah, the investment properties are for the assets, specific. Only the building, land, or the part of a building. The purpose of those two held for the capital appreciation or to earn rentals. If that is the case, we are classifying those as investment properties. So investment properties consists of the land, building, a part of a building or a land, which are held to earn rentals or the capital appreciation. And also if particular asset is the usage was not specifically mentioned, or the undetermined usage are also classified as investment property. However, like the rented motor vehicles and are also not part of this investment property. Only the land, building, and the part of the land or the building are coming here. So the investment property also we can apply the fair valuation as you mentioned earlier. For those investment properties which have been fair valued is having a rebuttable presumption where the presumption can be rebutted. Here the first one for the land, it cannot be rebutted, but here the investment property we can rebut for the assets recovered through the property through sale. The presumption is rebutted if the investment property and is held in order to consume the assets benefits over the life of the assets. Presumption is asset is here actually the some wrong is there. Presumption is rebutted if the asset is depreciable and is held in order to consume the assets benefits over the life of the assets. Can you cut it this one, say presumption is rebutted if the asset is depreciable here. Sorry for that one. The presumption is rebutted if the asset is depreciable and is held in order to consume the assets benefit over the life of the asset. Then again, the land which are part of the investment property are also not coming in here because they are not depreciable. However, the building which are depreciable and the entire value of the building, let's say you are trying to consume through the rent, then normal your business rates can be applied. So both criteria to be satisfied to investment property to rebut that one. So the principle was for the land, you are saying like for any land which is under the revalued model under PPE, you should assume that the asset is recovering through sale. So that's why when you are deciding the tax rate, you should have to apply if a sale transaction occurred, what would be the tax rate. However, for the investment property under fair valuation, this can be rebut. The rebution can be done if the asset is depreciable and is held to consume for the benefits of the life. Means let's say you are getting entire the value through the rent income over the useful life, because it's a depreciable means it having a kind of a useful life also. Then entire useful life you are getting the value through the renting. Then you can rebut and you can have a normal your use rate, which is your normal rate can be applied. However, other instances you have to apply the sale rate, which is sometimes maybe the capital gain tax rate, or your classification as a business asset would be your normal business rate also. So that is a kind of a, that part also the initially at the time of introduction, certain confusion was arose within the industry that rates to be applied for these kind of non-depreciable asset, especially the land, and different tax consultants had a different tax viewpoints on the accounting, the tax treatment also. So based on that, by applying the significant judgments, the financial statements, different the accounting firms were advising differently and different rates were used. However, the judgments were properly disclosed in the financial statements. So you can may have experienced those. However, the key takeaway was the land which are under revaluation model, you should have to assume that through sale rate is applying. Though you are not going to sell, still you have to book for the rate. The reason was land always you should have to assume you are recovering it through sale. But the investment property, you can rebut it if the asset is depreciable and you are benefit it through the end income entire useful life. So there are also, I believe, that can be applied for the kind of a depreciable asset, so like some sort of a right of use asset or a building, but not for a land. Can you please explain the treatment for land revaluation gain for tax purpose again? Yes, the land is an undepreciable asset. If a land under revaluation, we should assume that the value is recovering through sale. It is a kind of accounting specification, which we can rebut. And though, let's say you are having a land worth of the revalued model applied, and you are having a 1 million land, and the revaluation gain resulted 200,000. For that 200,000, you have to apply the selling rate, would be the business rate or the capital gain rate based on your classification. That rate, you have to recognize the temporary differences over the revalue gain. Let's say a company is saying like, I'm not going to sell this one. However, still you have to apply that one, because the reason was the standard says a land, since it is an undepreciable asset, you should have to consider you are recovering the asset through sale. So this is applying the Seranayaka. So do I need a further explanation? Let me know, then I can further explain. If yes, if you can mention yes, then I can move to the next one. Better if you can clarify what you are having now. We can have the computations later as well. Yeah, okay, fine. So any other questions considering those? Any other questions? Please put it in the Q&A. Definitely you should have more questions. Only I think the few people are raising the questions. The Shashni and this Senanayak has faced very valid questions. And I think Minoli also raised some valid questions. If you all are also having, then I can also like expand my explanations also. So any other questions? Okay. Right. We can move. This is for another kind of a principle, which is on the unused tax losses. How we should recognize the deferred tax assets on the unused tax losses. This is also a kind of practical application difficulties people are facing all the time, specifically due to the adoption of or the enactment of the 2017 Inland Revenue Act. It introduced a limitation. Only the 6 years period you can carry forward the unused tax losses. And also, I think certain reliefs were introduced due to the latest amendment to that. Also, the certain industries due to the COVID-19, a certain kind of new, specifically like a thin capitalization carried forward balances, certain kind of reliefs they have mentioned. Where the further extension of the claim period were introduced, those you can refer to the IRD Act and understand. Where specifically for the 6 year period was there for most of the companies, the carrying forwarding of the unused tax losses. So we have mentioned in the discussion today around this deferred taxes. At the very first slides, I have mentioned the deferred tax assets are coming through deductible temporary differences, unused tax losses, and through tax credits. So the unused tax losses can be claimed for the computation of taxable profits. Therefore, we are recognizing the deferred tax assets on unused tax losses if we can substantiate that those tax benefits can be obtained by the company considering the future taxable profits. So company is having the tax losses because company has made taxable losses in the previous financial periods, maybe including the current financial period. However, it might be indicate like the company may earn future losses as well. However, the company to recognize the unused tax losses, the company should prove that we are having future taxable profits or taxable temporary differences. So I will explain one. Let's say now we are having a kind of understanding about the taxable temporary differences. A company is having, let's say, a taxable temporary differences of 100. Your net figure of the deferred tax liability will come 100. Your next tax liability would be 100, let's say. And you are having the tax losses are also again 50. You are having unused tax losses temporary difference of 50 by applying the tax rate, and you are having a net tax liability position of 100 without having that. So without any justification on the taxable profits, since you are having a next tax liability of 100, the 50 can be set off against and having a net liability of 50. I will explain it again. To recognize in the unused tax losses, normally we are considering two aspects. First one is we are determining whether the company is having the taxable temporary differences. The second one is whether the company is having future tax profits. Let's say the first one I am explaining. The company is having a net tax liability position of 100 without considering any tax losses, and company is having a temporary difference of again 50 from the tax losses also. So the net liability is more than the next asset, means you can set off and having a net liability position again as a 50. That is also permitted. If the losses can be set off against the taxable temporary differences also, it can be done. Second thing is sometimes let's say net position is 100 and you are having a tax asset on the tax losses of 150. Now, if we are setting off, your net asset will come as 50, which it is more than your taxable temporary differences. Now, this book, this additional 50, you should have a kind of a justification of your future taxable profits. For that one, you have to forecast your future tax profits. If not be the accounting profit, you should have tax profits. So, kind of a forecast you have to make based on your assumptions and judgments. You might use your various judgments, the accounting judgments, and you have to put those disclosures if it is a significant judgment involved. That disclosure has to be coming into your financial statements and saying like you are recognizing a further kind of a tax loss based on your future recoverability, and this is the amount based on your forecast on the future tax profits availability. So I will explain again. There are two instances where you can recognize your the tax losses, the deferred tax asset. One is on the available of taxable profits. Available of the taxable temporary differences. Taxable temporary differences means if you are recognizing your deferred tax assets, deferred tax liabilities, the net position you are getting, if the net position is coming as a liability, then you can set off whatever the unused losses up to the extent of that. If let's say 100 is your next liability position, if the company is having let's say 150 tax assets without any harm, up to 100 you can recognize it without any justification about the future tax profit, since you are having a temporary difference of 100. For balance 50, you should have a justification of the taxable profits. That's you have to derive based on your the profits forecast. It's a taxable profit forecast. That's why the companies are struggling sometimes. Now we should have the forecast to be limited only the maximum of period of 6 years after incurring the tax losses. So some of the companies may have now the 4 years has lapses for the tax losses, now you can go ahead with another 2 years. So that expiration criteria also to be considered. So any kind of any other questions available for you? Your tax planning and the opportunities are also to be considered when you are forecasting your future taxable profits. So most of the time, the people tend to believe like for the unused tax losses, you can recognize only when there is a forecast available, not like that. If you are having a net tax liability position without having the tax losses, if you are having net liability position, still you can go till the maximum of net tax liability to recognizing the tax loss. The balance only you need to have the forecast on the tax loss, the tax profits forecast. However, you should have to consider now, due to this 2017 Act, the expiration of the period, which is the maximum of 6 weeks you can take forward the unused tax losses in most of the circumstances. But I have mentioned one kind of a small adjustment was made, the revision to the Act, where kind of a relief was given for certain industries. Any questions? Definitely you should have some questions around this one. I will give another 2 minutes. If you are having any questions on the tax losses, you can forward. Or if you feel like I need to re-explain, I can re-explain because we are having a time. How many years that we can carry for tax losses? It's a 6 years, the generally. There are variations for some of the industries. However, the generally it's a 6 years, not 4. But it is from the, at the time of the incurring, you have to consider, not from the balance sheet. Any other questions? Some other question is asking, this is not relevant to the deferred tax asset, but I will also answer in that one. When calculating the temporary difference for revaluation, should we take the net book value and the tax base? Yes, it's a net book value and the tax base. Net book value means the revalued net value, net book value after revaluation. COVID-19 might adversely impact of future profitability of companies. How these adverse conditions may impact recognition reliability? Yes. Your forecast, when you are having a deferred tax assets forecast, sometimes you have to consider this COVID-related implication. And now the economy is a little bit recovering and might have a kind of improvements are also there. You have to consider those aspects also. If you believe like or the industry, like we are having certain researches done by some of the credit rating companies or some other the central bank kind of forecasts available, we can consider those because now whatever the kind of IMF or some other institution, whatever they are forecast, normally the COVID-19 impacts are also considered by such institutes. So whatever the forecasts you have to consider based on your industry which you are involved in, what would be whether the future taxable profits any impact from COVID-19. There are industries where we have not affected through the COVID-19 and also some of the industries were severely affected, for example, the hotel industry. So if you are getting the forecast, you should have to consider how this COVID-19 would be reflected in your future. So the justification for that, you can refer whatever the research articles done by the central bank, IMF, or some other credit rating agencies, which are publicly available, even the Google, you can find out. The Daily FT had contained various articles done by the various experts in the industries. So those can also be referred and taken into account. Or if required, you can consult some
experts also in deciding that one. If the industry was very severely affected and you are feeling like you might not be able to done a precise forecast on the taxable profits. But that we also consider the recovery of the economy also. This definitely you should have to consider the COVID-19 impact. If the your company, the industry which the company is operating, if it has been severely affected, definitely. Any other questions? Okay, so far I didn't get any questions. Let's check for that one. If you are having anything, please forward to me. And finally, we are coming into the disclosures, whatever to be made in the financial statements, which are on the tax expense related to profit, then equity related taxes, the aggregate current and deferred tax related items charged to the equity. If it is directly charged to the equity, normally it's very rare. And the tax expense related to the gain or loss on discontinuations, if a discontinued operations are presented in the P&L, the tax expense for those to be disclosed. For example, the SLFRS 5 says like if you have a discontinued an operation, a separate kind of if it is a major line of business, you are presenting it separately in the face of the P&L, and the related tax consequences are coming also to part of that. If due to changes and errors, that is also one of the key things which I need to highlight. Whenever we can say sometimes
Dear students, please be patient because something has happened to the resource person's connection. Once it become normal, he will connect it as soon as possible. So that till then, please be online.
Sorry, there was a connectivity issue as there was. Hope I'm audible now.
Yes, Chatumi, you can go ahead.
Okay. Okay, thanks. Sorry for that one. Issue was came. Where I stopped was these changes in the errors. Like, for example, like normally we are doing the prior period adjustments based on whatever the prior period errors that we have encountered. I have seen sometimes when the people are not considering the consequent tax, the deferred tax kind of impact when we are when we are making an error. Let's say we are making kind of an error which is affecting to the carrying value of the PP items. Definitely there is an impact to the deferred taxes also because your accounting base is getting impacted. But I have seen some of the instances where the people are not considering the deferred tax consequences. So you should be mindful when you are making a prior period error, definitely consider whether there is any impact to the deferred taxes also. And also the other thing which I am this is relevant for the auditors. If the auditors are qualifying the certain balances, we cannot just confine to the, let's say, the PP existence we are qualifying. Sometimes they might have a kind of a related impact to the deferred tax and the income tax balances also. So we should have to mention if the impact is material, we should have to mention that one also in our qualification. That's for the auditors. So that is also be mindful when we are dealing with that, because the tax consequences are affecting the several line items in the balance sheet. Then tax expense and adjustments, the major components of tax expense, basically the current tax expense and the deferred tax, I have to present. The temporary difference reversals has to be disclosed. Then the tax expense, if the reduction of taxes has happened, those, and the write down of a deferred tax asset. If the changes of the applicable tax rates, like in this now, this year, the March companies, there was a change in the tax rate, that has to be done. Then a reconciliation to be presented based on the profit multiplied by the applicable tax rate, which I will show it to you through the application guidance, how we should derive that. And the deductible temporary differences, the expiry date or anything, that has to be also to be disclosed. Then the current and deferred tax items that are charged to the credit, the equity, each type of a temporary difference, how much is the value recognized, and the P&L impact. And also the dividends, what we have proposed, which are coming at the events of the reporting period. That part also we should have to disclose the tax consequences. That is also most of the time people are missing. The dividends which are we are disclosing as the events of the reporting period, which have been proposed but not still declared. They are the tax consequences are also to be disclosed. And those are the major disclosures, which I will show it to you the reconciliation, which we are referring. Most of the time I have seen the companies are doing their own kind of a disclosure for this one. However, the expectation of the standard is a little bit different. So before I am moving to that one, if you are having any questions, please forward it to me. Any questions? This different tax rates application, actually this Sarath is asking SMEs had a different kind of tax rates. So I can discuss here about the accounting treatment is applicable there. So if you have tax related one, I'm encouraging you to consult with the tax people. But I can consider for the deferred tax and the current tax calculation, the accounting principles behind that and how we should treat those for the accounts. I can explain to you. But we should have to compute the tax computation first through the tax consultant. We can consider to make a reliable estate COVID for our annual accounts at the year end. Now, actually, initially, when the COVID visa appeared in 2019, it was a little bit like 2020 that we had a lesser kind of information available without undue cost and effort, and we struggled to have certain judgments and assumptions which we are making. Now we are having it's become a new normal now. So now we are having more precise kind of articles, the research publications, and we are knowing that the instruments are there. Yes, if the company has severely affected from the COVID-19, normally we are making a disclosure, which is for the understanding of the users. We are putting that disclosure. Specifically, some of the companies, this has been linked to the going concern of the companies also. If the company is having a material uncertainty or if the indicators are there to give an idea about the uses of the financial statements, the company's position, having considering the COVID-19 impact, it is a kind of it's a really kind of based on the user's understandability, we should make that disclosure in our financial statement. Some of the company industries we can ignore because those industries were not severely affected. But for the industries where it was severely affected, like especially the hotel industry or the travel agents and other related industries, definitely this disclosure is nowadays a part of their financial statements. That's for the understandability of the financial statements. Hope I have clarified this. Employees, can we measure expenses? This is kind of a LKAS 12 discussion. So this is kind of a certain questions which I'm getting are not related to LKAS 12 also, which is a kind of a detailed explanation which we can have a different forum. We can have a look where how the LKAS 19 was impacted. So due to the time limitations and the benefit of the other people, I would like to confine for the whatever the discussions around in the LKAS 12. So Minoli, if you are having a kind of a done, we can have the discussion offline or can discuss in a different forum. Can you explain how the capital gain of 10% is considered for deferred tax calculations? That one actually based on your classification of your asset as an investment asset for the business asset, you should have to apply the capital gain tax rates. Here, actually, the different tax consultants had a different views to application of the classification of investment assets or the business assets, specifically the land. However, based on once you have justified one of your assets as the investment asset, you can apply the capital gain tax rates for the fair value gains. The temporary differences normally result in is the cost minus the fair value amount. So that amount, the entirely you can consider for the tax rate 10%, which is applied for some of the investments also, which is confusion was aroused, but for the land, actually, the confusion was aroused, and based on your judgment or the consultation with the tax consultants, you can have the precise deferred taxes for that. Anyway, if you have classified a particular asset as an investment asset for the purpose of the taxes, the Inland Revenue Act purposes, then you should have to apply the 10% tax rates for the any fair valuation gain resulting from those assets. Hope, Karindu, I clarified your question. Any other questions? So I'm very happy to see the most of you are getting questions. And also, if I am answering this Shasni's question also on this, the different tax rates if you are having, normally nowadays what I can see is if you have different tax rates, the two calculations are deriving. Some of the assets, if you could specifically identify, let's say you are having two different tax rates, the 18% and the 24%. If you can specifically identify
one particular asset is belonging to the business operation, which is subject to 18%, you can have the temporary differences by the 18%. It can be applied. But if you are having a segregation, like the asset is used for both, you can have a kind of a weightage one where you can derive it from the revenue in proportionate to your taxable profit, or that kind of a weightage you can decide, and the weightage average, the tax rate can be applied. That is based on your judgment. You can, if you feel like more reflection is on the revenue, you can have that one. But specifically, you can decide and you can segregate the asset into that component. You can segregate and decide the temporary difference. That is also permitted, and which is the more relevant or the more precise way to determine the taxable temporary differences. So any other questions, or if Shasmi needs to clarify anything on the whatever the is a question? Since you have not any questions, our Q&A is there. Oh, I have answered all. Right. So the disclosure, I promised to show you this reconciliation, how it has been done. So there are three materials we have circulated with you. If you can go into this one. IS 12 implementation guidance, there's a separate kind of a thing I have circulated with you. This one. This is a kind of the pronouncements issued by the ISB, which we have circulated here. They are having certain kind of the related literature also, certain kind of how they pay valuation, whatever the content which I have explained here also contain it. And it has certain kind of the disclosure how we are making. A disclosure to be the reconciliation for the income tax, the tax expense and the accounting profit has to be done. That also you can see here. This is how we could done this one. It says the accounting profit first we have to consider these comparative amounts also to be disclosed. Then we have to apply the tax rate and for the accounting profit, and that figure we have to get. So here it's 775 into 35% in this year, 40% in here. Then whatever normally what we can see is nowadays the people are providing the absolute figures for the reconciliation, not actually the absolute figure. The standard requirement is to present the tax effect. So here actually these differences are also to be multiplied by the tax rate and get this figure. So here the difference is the tax effect, not the exact amount. So that one also to be applied, and the tax expense you have to get. So this is the disclosure, which is the reconciliation between the tax expense. This is the easiest way. Or you can present based on the rates also. You can use this one. I prefer if you can go it with this method, which is more kind of easier method. Even the tax rate also to be presented in with this one. And also, like if you are having changes to the tax rate, the reduction in open and deferred taxes here present in, like now you are having the previously 28%, now it goes down to 24%. The 4% gap is coming in. So your opening tax, deferred tax liability into the 4% difference also to be present separately in here as a reduction in opening deferred taxes in the tax rate. This is how we should derive the opening tax liability multiplied by rate change. Let's say previous year and you have 1,000 in the deferred tax liability, your tax rate change is 4%, then you are having 1,000 into 4% is coming in here. It is how you should derive opening deferred taxes resulting from the tax rate. It is now to be presented separately. That is also the requirement under the LKAS 12. So that is the kind of the disclosure which you have to make. So any other the questions you all are having surrounding this? Before moving to the questions which I have sent you to you. If you need a further kind of explanation, whatever I have discussed today, we have discussed firstly the current taxes, what kind of things are there in the current taxes, how we should determine the current tax, then the prior period adjustments, how we should apply the tax rates to be used for the deferred taxes, the temporary differences, the initial recognition exemption, the fair valuation, how we should treat for the tax purposes, then the disclosures finally on this reconciliation and other related disclosures. Those all we have covered. So if you all are having any kind of the clarification, the really kind of emphasis you need to do that, you can forward to me before going into the questions, which is we can have another around 40 minutes there, where we can leisurely include on the discussion of the discussions around in the more on the application. And if you are having any questions, you can forward now. Even better, like the people have highlighted the COVID-19 impact also. That is also a good thing. Any questions or any practical difficulties you are encountering, you can refer. So I can give another, let's say around 2 minutes till 11:50. If you are having any questions to raise, sometimes you all might be typing this still. No questions? Anything what you have learned today, you can ask. No questions are there, we can, one Q&A is. Can you explain the goodwill adjustments in paragraph 21 of LKAS 12? Paragraph 21, I referring the initial recognition exemption. Let me to check.
Yeah. This is kind of actually this goodwill thing is not that much applicable for Sri Lanka since in Sri Lankan context we are not having a group taxes. This is resulting like if the goodwill sometimes if they are having a tax consequences, how that should have to be resulted. So most of the time we are recognizing the goodwill on the consolidated financial statements. So those instances where if the jurisdictions where they are having the group taxes, how the goodwill has been treated is there, which is how the goodwill has to be treated for the tax purposes. In Sri Lanka, most of the time, for the individual officers, it's very rarely coming in. If a particular asset acquisition has been concluded as business acquisition, we are getting the goodwill. So, however, that is also the normal intangible assets, how we are booking for the goodwill that can be applied. Here, normally, this is much more relevant for the consolidated financial statements where the jurisdictions, the tax returns are filing for the group level. This is much essential to be applied, not for a relevance in the Sri Lankan context that much. The goodwill, the application. It is also a kind of an exception to the initial recognition, which I have explained to you through the business combinations, which is also a link to that one. That's why I didn't touch on the goodwill, since it's not that much related to the Sri Lankan concept. Any other questions? So far not. Okay. We can move into the questions to discuss, where you can refresh your knowledge through this one. I think we are having around 23. Let's try our maximum to go. And I'm suggesting you all to have a kind of a chart where it says your accounting base, the tax base, temporary difference, if you can put that. After that, the deciding the deferred tax assets and the liability is only the multiplying by the tax rate, which is the enacted or substandard tax rate at the balance sheet date. So it is not a big issue. The determination of temporary difference is the issue for most of the people. So you can have your accounting base, the tax base, and the temporary difference. So let's go ahead with one by one. So I am not going to answer. You are going to answer based on what you have learned so far. The question one is that an entity has an amount receivable from customer of 5,000 that has no allowance for bad or doubtful debt set against it. The receipt of cash settlement of the balance will have no tax consequences for the entity because the revenue has already been included in taxable income on sale of the goods or performance of the services. So let me say the accounting base anyway, no issue. Accounting base you can put as 5,000. Based on your assessment, what would be the tax rate? Just read it out and see. Hope everyone got this one, the questions to discuss. If not received, please check the emails where the invitation received. It should have the attachment. Can I have the answer for the first one? What would be the tax base? Don't leave, like these questions are also contain some of the principles. Please read it out and see what would be the tax base. In the chat box, please put. Hope everyone is there. Only the first question, can I have the tax base? Am I audible? Parinder is there, the Senanaik is still there, Minol is still there, Sashni is still there, the activity who have asked the questions I am referring.
Yeah, 5,000, 5,000. Yes, the accounting and the tax treatment both are the same. So you have that knowledge now. The accounting and the tax both are the same. That's why the receipt of the cash in settlement of the balance will have no tax consequences. Mean it's not the tax consequences or not, but it says the revenue has already been included. That's why no tax consequence. That means the accounting and the tax treatments both are the same. So that's why the 5,000 will come. So now everyone will understand that. Okay, good. The second one, which might be a question, the entity has interest income receivable 5,000. The interest income is taxable when received in cash. What would be the accounting base anyway 5,000? What would be the tax rate? Now different account, accrual and the cash basis. Put where there are temporary differences, which is a taxable or deductible also. That is also essential to recognize. Otherwise, you are coming up with a different wrong account. Second one, let's say, since both are 5,000, all are most of the 5,000. That's why I am confusing now whether I am receiving the answers for the second one. Can you put 2 and say your answer? Because both these questions are having 5,000. Just say 2 and put your answer. I think 38 participants are there. I actually wanted to clarify if I feel like I have you are getting a wrong answer, then I can re-explain the principles also, which is beneficial for you. So please you may have the right answer or the wrong answer, but put it into the chat box. Then I can explain that one to you. Since we are having another 30 minutes, we can do much more the explanations. We are getting one answer which says P0. Any other thing? Okay, tax base is 0. Tax base is 0. Yeah, the different accounting is applied for the tax purposes, not receivable. Is 0. Okay. Good. Second one is an entity has dividend receivable for 5,000 from an investment in equity instruments in another entity. The dividends are not taxable. The received when recognizing profit or loss. What would be the treatment? Which I have already explained in the presentation also, the same kind of a question. What would be the third one? No tax consequences. Temporary difference is 0. Yes. The tax base and the accounting base both are the same. You could remember, right? If the no tax consequences, we should have to consider the tax rate. If the no tax consequences, tax base and the accounting base, we should have to consider as the equal amount. And the temporary differences would result 0. That's one of the principles which I have mentioned, where the accounting base and the tax base we should consider as same amount, and the temporary difference would be the 0. Don't forget that. I think some people put 0 for the tax base. Tax base is also the 5,000. The temporary difference is 0. Both those are the same. Cash at bank 5,000. No tax consequence for the withdrawal means 5,000, 5,000. The 0. The temporary difference is 0. Accounting base 5,000. Tax base is 1,000. Right? Okay. Now we are moving to the fifth one. Entity holds an inventory of finished goods at cost. Inventories are deductible for tax purposes when they are sold. The deduction is equal to the cost of the inventories. What would be the tax base? Fifth one. Inventory 10,000. Inventory is deductible for tax purposes when they are sold. What would be the rate? The fifth one. think and answer. No tax differences means what is the tax base? Can you explain? Try and see. I can give another 1 minute to come up with the answer, 1 or 2 minutes. Please think and learn. Then you will understand. I always say like people are struggling to defer taxes because they are going with they try to remember everything and go. Don't do like that. You will have to learn the principle and then you can get the answer. It's very much easier. The tax base is 1,000 one is thing. Okay. Right. Here, actually, the fifth one, the accounting and the tax, no difference because in the accounting purpose also, the inventories we are charging to the P&L at the time of selling as the cost of sales, right? So there is no difference between the accounting treatment and the tax treatment. So your accounting base and the tax base both are become same. Yeah, tax base is also the 1,000 because the accounting treatment and the tax treatment both are the same amount. That's the reason. Then sixth one, an entity owns land that meets the definition of investment property. So land to meet the definition of investment property, either it should be held for the rent purpose or the capital appreciation, and is measured at fair value 210,000. No tax is payable or recoverable on the proceeds of sale because there is no capital gain tax in this jurisdiction and there are no other tax effects on sales such as clawback of tax deductions given during the use of tax. So during the use of also you are not getting any kind of capital allowances and also no tax consequences from the sale also. Let's say what would be the tax carrying value? This is not applicable for Sri Lanka. Because Sri Lanka, we are having now the capital gain tax. In here, actually, the no capital allowances are also receiving and no any tax consequence from the selling also. So what would be the tax base? It's simply saying no tax consequences. It's more similar to the like nowadays the traveling purpose motor vehicle, right? So what would be your kind of your tax base? Land, always we have to assume that we are recovering it through sale. That is also I have explained. We have to assume that land always we are recovering through sale. Okay. The reason was here, the land, which is land, I said like the land always we have to say is an undepreciable asset, which we have to assume that the recovery is through sale. So here if when it's going to sale, no capital allowance, no tax effect. So the same thing was there the previously before the adoption of the 2017 Act also. We are not charging for when we are any providing any deferred taxes on the fair valuation of land. The reason was land always we are having assumed that it will recover through sale. So if the sales, they are not having any kind of consequences, then we do not have any temporal differences. So your accounting base and tax base both becomes the same amount. There are no any tax consequences are resulting. The reason why non-depreciable asset, the logic behind that was the non-depreciable assets, why we are assuming it's always realizing through the sale was the reason that since it's an non-depreciable and the value is not depleted in over to the use, we have to get the anyhow the ultimate value through a sale. Use for the consumptions, we cannot get the value. That's the reason we always assume the land recovery is through sale. And if the sale is not subject to any taxes, and on the other hand, no any capital losses also claimed, so we should have to consider both are the same. So here no tax consequences are derived. Hope everyone understood. If not understood, let me know, then I can explain again. That means revaluation on is exempted. It's kind of exemption, yes. Same. Somebody can argue like exemption. That one also a valid argument. Somebody can say both are the same. Somebody can say it's exempted and zero rate is applied. That's also permitted. Anyway, no tax asset or deferred tax asset or liability ultimately booking. An entity owns land that meets the definition of an investment property. The land was acquired 2000 at the beginning of the financial year. If the entity disposed of the land at the reporting date, it would be entitled tax deduction of 201,000 due to indexation of cost for tax purposes. The land is measured at fair value with changes in the fair value recognizing profit or loss. The fair valuation is 210,000. So the investment property, please assume that it is on the fair valuation and land is measured at fair value, it says, right? And it was land that made the definition of investment property. The land was acquired 2000, which is the cost, right? But in due to that kind of certain jurisdictions are side indexation, anyway, you can claim 201,000. However, the fair valuation of the land is 210. So what is your accounting base is 210,000 because that is the accounting base. What would be your tax base? Normally in Sri Lanka, actually we can claim only 200 in one day. Like, what is the 201,000 they can claim? So your tax base would be the 201,000. So temporary differences of 9,000 would arise. Your accounting base is the fair valued amount. Since it is going to be tax, means the definition would be tax deduction is available for that one. That means the tax consequences are there. Since it is deductible for the tax purposes, so you are getting a tax benefit of 201,000. That is your tax, the deductions you are getting in. At the day one. So due to that, any other future period, you have to result in tax profits in future. So this is similarly in Sri Lanka also, we are getting at the time of disposal, you can claim what only the realization gain would be taxable. So you can get the difference between the cost and the fair valuation. Only the temporary difference would result in from the whatever the margin above that, which is subject to the deferred tax liability. Here also a taxable temporary differences is resulting. Any questions on that one? Can you go to the next one if no questions, the 8th one? This one, I think you can have the answers. And it has machinery, 100,000 measured at depreciated cost.
The machinery is deductible from taxable income either as the machinery is used, alternatively on sale. The tax depreciation is applied on the same basis as depreciation for financial reporting purposes. 25,000 in each year, 4 years its useful life. This machine has residual value of nil. Revenue generated by using the machine is taxable, and any gain or loss disposal of the machine will be taxable or deductible for tax purposes through balancing adjustment. Yeah, here actually one principle we have to apply where we should have to consider the recoverability of the asset, which says first establish whether we are going to recover the assets through sale or through use. Normally, the machinery, if having a useful life, is equal to the whatever the useful life is equal to the economic life, means the company is going to use the entire asset kind to be recovered through the use. However, the certain companies might decide we will consider the part of the asset through the sale also. However, the company, I think in here, normally in Sri Lankan context also, normally the machineries are recovered through the use. If the company is through use, they have to claim the capital allowances through use. In here, different jurisdiction was applied where alternatively on the sale also they can claim. However, since the company is kind of getting the usage, at least more than 1 year, they are getting the capital allowances throughout the period, which is also equal to the depreciation cost also, where no temporary difference is generated. The reason was the capital allowances claimable period and the useful life both are the same as per the question. So first we have to establish they are going to recover it through use. After that, we have to apply the related tax rates. So in here, like in the most instances in Sri Lanka also, the machinery, we are normally recovering through use. Land was, this is the only where we are having a kind of a presumption, always recovering through sale. The next one also, you can have the different kind of rates. Again, you can adjust the tax rate where the 15% deductible for tax purposes. Like in Sri Lanka also, we are having a mismatch between the tax rates applicable for the accounting and the tax rate applicable for the taxes also. The differences are there. So due to that, based on that, you can calculate the tax base. Please have a look on the 10th one, which is also somewhat, in Sri Lanka, the listed shares are not taxable. However, the unlisted shares, you may be able to use this concept. The shares cost 800. If the entity disposes the shares at the reporting date, it will be entitled to a tax deduction equal to the cost of the shares. At the reporting date, fair value is 1,000. What would be the tax rate? In Sri Lanka, actually, the listed companies, the shares are not subjected to taxes, so therefore no temporary differences are arising. However, the unlisted, based on the capital gain, you have to book for those. In here, let's say, to try out and see what would be your tax base. Anyway, the accounting base is 1,000, which is the fair value. What would be your tax base? What will be your tax base? Can have any answers? I will fed up with that one. Or still you need to clarify something, please let me know. Yeah, tax base is 800. That is the amount you are going to recover. So your temporary difference would be the 200 because you are entitled to a tax deduction of 800.
The related gain will not result for the taxes because at the time of disposal only, you are getting the benefit. Eleventh one, an entity acquired a license 5,000 that has a useful life of 10 years. The intangible asset is expected to be used for the full 10 years. Its carrying amount is 4,500. No tax deductions can be claimed as the license is amortized or the expiry. What would be the rate? Let me try out and see the 11th one. So can you share an answer sheet with a small explanation for all quiz? Yes, I will do. May not be the today, but during this week, I will try my best to share with the explanation also. So let's try and see. Main thing is you need to identify the logic behind those. I am very happy, like sometimes people are asking to explain the theory behind that, the logic behind that also. That's very nice to see that. The reason was, this is a practically we have to apply. The practical application, the remembering an application is not a good thing for the deferred taxes. The reason was you should have to understand the principle behind that, then you can easily compute the deferred taxes. The most of the time the people are struggling was they are not understand the logic or the principle behind that and doing a wrong accounting. Since these are very much the practical application, still the knowing the theory is also very much essential. So this license, what could be the this carrying value? Let's try and see the maximum 1230. I will anyway share the answer. So assuming that one don't leave, like you will anyway share Kayla. Any questions? So anyway, I will up to after this another 1 or 2 questions, I will stop and I will share the answers also during the week. After that, I will again allow you all to come up with certain questions or clarifications if you all are having. Can I have the answer for this, the 10th, not the 11th one? Can I have answers? So by the time I suggest you to try out and see in your own whether you can compute the come up with the related answer. Why I have not considered these the Sri Lankan specific things, I try my best to explain also with the examples, but I am having more examples than these Sri Lankan specific. The reason was the tax laws are also changing and you all should know the principles behind that to adapt whenever the changes are happening. Otherwise, different accounting treatments are coming in, the people are struggling to do the accounting. Sorry. I have not limited my explanation only for the current applicable law. The reason was that we should have to understand, try and see the more questions or more practical issues, then we are more suited for any kind of a revision. Still, we can compute the deferred taxes. That's why some are not Sri Lankan specific scenarios are also there in here, which I have not removed from my explanation or the question. So the 10th one can at least a few can please the 11th one can have certain answers. Then we can see and move into again the Q&A session. By the meantime, if you all are having any Q&As also, please put it into the Q&A box.
So here also the no tax consequences means the 1,000, 4,000, the entire carrying value will equal to the tax base. At 31st December 2001, an entity has a gross trade receivable 50,000 with an allowance for bad debts 2,000. The allowance for bad doubtful debt is only tax deductible when the tax debt is 6 months overdue and has been written off or sold. The entity is reporting their debts which they were 5 months old or less. So they didn't write off it. So that means the entire 2,000 can be recoverable in future. So your tax base is around 0, but the accounting base is 2,000. You are having a temporary difference of 2,000, which is going to be recovered in future year. That's why in Sri Lanka also, at the time of write-off or the written off, you are getting a tax benefit for the debtors or the inventory. So whatever the provisions, we are normally recognizing the deferred tax assets. The reason was at the time of written off, you can get the entitlement as a tax credit in future years. So in here also you can get the 2,000 the tax credit. Then an entity is required to pay fines of penalties because in the past year it violated minor laws. The entity is recognized liability 100, no deductible. This is also explained in the presentation also. There are the no tax consequences, meaning the accounting base and the tax base both are the same. If let's say the 14th one, can I have answers? Entity recognize a warranty provision cover the repair. The amount recognized provision is not deductible until paid. What is the accounting base, the tax base? 14th one, can I have the answers? Can you give the answers in a worksheet in future? Yeah, I will. That's why I said like I will circulate it during the week. You can, by the meantime, you try your own, and when I'm receiving that one, compare and come up, check with the answer. It's best thing is to try your own. Let's say, can I have the answers for the 14th one? Tax base? No one is answering. Tax base is 0, yes. Some other answers. Now it's about to finish. This is at 12:30. Yeah, 0. The reason was we are getting the entitlement for and took on the payment. That's why in Sri Lanka also the warranty provisions, the same principles are applicable. You are recognizing the 0 and the temporary differences would be the entire carrying value. The same thing apply for the gratuity also in Sri Lanka. Where at the time of payment only you are getting the entitlement. Bank loan 50,000 loan repayment no consequence means the carrying value and the tax base both are the same, which I have explained. So rest of the thing I will not going to discuss, and I will send you my the email through I will email it to you and circulate through Samanthi Augusta the answers at the end of this week. So till that, please try your best to come up with your own answers, and I can forward my email address, which is also beneficial for you to come up with. If you are having any clarifications or something, you can just forward it to me through this one. And also, I am always saying like we always keep up to date, and we need to understand the technical literature available. That's why in the beginning also I showed you all the web page where the maintained by the Sri Lanka Accounting and Auditing Standards Committee to get your whatever the related accounting pronouncements. A little bit confusing when we move to the practical quiz. Can we have some key heights, and that may help us to solve? Okay. Anyway, I will show it to you one. Maybe some of you all might aware. This is the kind of the Deloitte website is available, which contains certain e-learnings which are freely available. Anyone can access, and kind of certification can also be obtained through that one. The IAS Plus website, which has kind of e-learnings which are accessible to you on free of charge, which is also having the LKAS 12 related this e-learnings also, which I will share the link where it has all the kind of the links also there where you can practice your own to come up with. I will put in the chat box the related link where the e-learnings you can have a look and you can do your own. There are 2 e-learnings are available on LKAS 12, which is also useful for you all. And anyway, my email also there. If you need any further clarifications, you can approach to me. No any harm. This is available for all these standards, but LKAS 12 also having the 2 set of standards, 2 set of e-learnings. And not only the Deloitte, the rest of the other accounting firms are also having very valuable publications, which you can refer. The other firms are also maintaining very good kind of a combination. This is particularly for your learning purposes. I have circulated this one. My email, I think from the chat box I have mentioned. If I need, I can put it again. When accounting for revaluation, the revalued amount is shown as reserve and it is netted when the asset is revalued again should be DT plus revalued amount or net value. We should have to calculate the whatever the temporary differences based on the carrying value. If a revaluation was done, the carrying value after the revaluation. If the year end, it is a revalued amount. If not the year end or the subsequent year, not revaluation was done, it is a revaluation after the depreciation. Whatever the carrying value to be considered for the temporary differences calculation. Hope that I answered. It is not the reserve we should have to consider. The link is not visible. Just put it in the chat box, not the Q&A. We are referring to the DT adjustment in OCI netted with the revaluation reserve. Yeah, that deferred taxes, what you are coming to the OCI should have to be netted off against the revaluation reserve because it is specifically applied for the revaluation. It is netted off against the revaluation reserve. That's true. Initially, the current year adjustment coming to the OCI, then should go to the revaluation reserve. So have you received this one? I don't know. E-link also, what receiver saying. I can't, maybe one time I can try. I think I sent it to host and panelist, maybe everyone. Now maybe you can have the link.